So far we have learned what the forex market is, how big it is, and how currencies are traded in pairs. But now the big question is, how do you actually trade forex?
If forex has ever felt confusing, you are in the right place. Welcome to Nesh Trades, where we break it down and make it simple.
How do people participate in the forex market as traders? In this lesson, I'm going to break it down in a simple way and show you the different ways you can get involved in forex trading. So let's get into it. How to trade forex. Now, when it comes to trading forex, there isn't just one way to do it. Because the forex market is so big, traders have created different ways to invest or speculate in currencies. Some of the most common methods include retail forex, spot forex, currency futures, options, ETFs, CFDs, and spread betting. Now, don't worry, you don't need to understand all of this right away. In this lesson, we are focusing on the methods that are most relevant to you as a retail trader. Some of the more complex ones are mainly used by big institutions, so we won't get deep into those for now. So with that in mind, let's break down the different ways you can participate in the forex market. Let's start with currency futures. A future is simply a contract where you agree to buy or sell something at a specific price on a future date. So in forex, a currency future is an agreement to buy or sell a currency at a set price but at a later date. These types of contracts are traded on official exchanges, which makes them more structured and regulated. Because of this, prices and transaction information are clear and available to everyone. In simple terms, you are locking in a price today for a trade that will happen in the future. Now let's talk about currency options. An option is a type of contract that gives you the right to buy or sell a currency at a specific price in the future, but you are not forced to do it. That's the key difference here. You have the choice to get ahead with the trade or not. However, if someone sells an option, they are obligated to complete the trade if the buyer decides to use that option. Just like futures, options are traded on official exchanges, which means they are regulated and structured. But compared to other forex markets, options usually have limited trading hours and lower liquidity, so they are not as commonly used by beginner traders. Let's talk about currency ETFs. A currency ETF is a way to trade currencies without actually trading them directly. Instead, you are buying a fund that represents a currency or a group of currencies. You can think of it like buying a bundle that tracks the value of currencies. These funds are created and managed by financial institutions and then sold to the public on an exchange, just like stocks. This makes it easier for beginners to get exposure to forex without placing individual trades. However, unlike the forex market, ETFs do not run 24 hours a day. They also come with additional costs like commissions. So while they are simple to use, they are not the main ways most forex traders trade in the market. Now let's talk about spot forex, also known as spot FX. This is the main and most important part of the forex market. The spot forex market is an over-the-counter market, which simply means there is no central exchange. Instead, trading happens electronically between banks, institutions, and other participants around the world. That's why the forex market runs 24 hours a day. In this market, trades happen directly between two parties. So instead of using a central exchange like stocks, participants trade with each other through networks. The biggest players here are banks and large institutions. They trade huge amounts of money in what's called the interbank market. This is where most of the real forex transactions happen. Now, here is an important part to understand. When a trade happens in the spot market, it is actually a contract to exchange one currency for another at the current price. For example, if you buy a Euro USD, you are agreeing to exchange US dollars for euros at that current price. Even though it's called spot, the exchange doesn't happen instantly. It usually takes about 2 business days for the transaction to be completed. So here is the key thing for you as a beginner trader. This is not the market you directly trade in as a retail trader. Retail trader access the forex market through brokers, which we'll talk about next. So the spot market is the real global market where currencies are exchanged between major players, and everything you see as a retail trader is based on what happens here. Now let's talk about retail forex. This is where you and I trade. As individual traders, we don't trade directly in the main forex market. Instead, we access the market through a forex broker. These brokers connect us to bigger markets, get prices, and then display those prices on our trading platforms. You can think of it like a shop. It gets prices from a supplier and then shows you its own price. Now, something important to understand is that your broker is usually the one taking the other side of your trade. So if you buy, the broker sells, and if you sell, the broker buys. Now, here is the key idea. You are not actually trading real currencies. You are trading a contract based on the price of a currency pair. So when you trade something like Euro USD, you are simply predicting whether the price will go up or down. These trades are also leveraged. Leverage allows you to control large positions with small amount of money, and this means you can open bigger trades than the money you actually have in your account. Now, in the real forex market, currencies are supposed to be exchanged after a trade, but in retail trading, that doesn't happen. You don't receive real euro or dollars. Instead, if your trade stays open, your broker automatically keeps it running by rolling it forward. This avoids any actual exchange of money. When you want to exit a trade, you simply close it. If you bought, you close by selling. Your profit or loss is the difference between your entry price and your exit price. If your trade stays open overnight, you may either pay or receive a small fee. This is called a swap or rollover fee. So in simple terms, retail forex trading is all about speculation. You're not exchanging real currencies. You are trying to profit from price movements in the market. Now let's talk about forex spread betting. Spread betting is a way to trade in the market without actually owning anything. Instead, you are simply betting on whether the price of a currency pair will go up or down. So the price you see is based on the real forex market, also known as the spot market. Your profit or loss depends on 2 things: how far the price moves and how much you placed on the trade. So the more the market moves in your favor, the more you gain, and if it moves against you, you lose. This type of trading is offered by specific providers, mainly in certain regions like the UK. And it's important to know that spread betting is not allowed in some countries like the United States. So spread betting is just another way of speculating on price movements without actually owning the currency. Let's talk about the Forex CFDs. A CFD, or contract for difference, is simply a way to trade price movements without owning the actual asset. In Forex, this means you are not buying or selling real currencies. Instead, you are entering a contract based on the price of a currency pair. Here is how it works. You open a trade at one price and later you close it at another price. The difference between those 2 prices is either your profit or your loss. So if the market price moves in your favor, you make money. If it moves against you, you lose money. Another important thing is that you can trade in both directions. You can buy if the price will go up, or you can sell if the price will go down. Just like other methods we have discussed, the price of a CFD comes from the real forex market, the spot market. So in simple terms, a forex CFD is just a contract where you profit from the change in price of a currency pair without actually owning it. And depending on where you are in the world, this is actually the most common way retail traders trade forex. Nice, you have just completed this lesson, and if you understood everything, that's a big step forward. If not, take a moment, go back and make sure it clicks. Now let's quickly look at what we have covered so far. We started with understanding what forex is, then we look at what is actually traded in the forex market. We broke down how currencies pairs work. We explored the size and liquidity in the forex market, and finally we have looked at different ways you can trade forex. So this officially brings us to the end of our first chapter, what is forex. Now we are moving on to the next chapter, how do you actually trade forex. In the next chapter we are going to start getting practical. We'll cover things like how traders make money, when to buy or sell, what a pip is, what a lot is, spreads, other types, and much more. This is where things start getting real. So let's track our progress. What is forex completed? Now we are moving into chapter 2, how do you trade forex. Step by step we are building your understanding, and you are already ahead of where most beginners are. So let's keep the momentum going. I'll see you in the next lesson.